Good morning. Thank you for joining us here at TradeWinds with a webinar on an important topic that is probably on your mind, and if it's not, hopefully after today, we're here to give you some ideas or our thought process with how we attack a pretty important concept as investors, as financial planners, and of course, as people looking to do well with their financial resources. I am joined this morning with one of our financial advisors here at TradeWinds, Jeb Bowie. Thanks for joining us, Jeb.
Yeah, man, I'm happy to be here. It's my debut on the TradeWinds in front of a TradeWinds camera, I guess.
It is your debut.
Yeah.
I'm excited for your face to be on the big screen. We'll see if you can make it to Hollywood one way or another.
I'll do my best. I'm following your lead, man.
Good deal. We are talking about a pretty big question today, and I'm thinking for our time this morning, we can unpack the question because there's a lot to it. Okay. The question is this, effectively, why is the stock market continuing to reach all-time highs, continuing to do so well, despite the world around us seems to be falling apart?
Yeah.
There's so much going on in the world and the headlines, and from politics to war to the economy. It seems like things are pretty dark right now. I'm excited to have you with me today as we unpack a lot of that and some. Maybe more importantly, what do we think? How do we approach this as financial planners and trusted sources of advice and information for the people that we work with? You have any initial thoughts or considerations just on the question before we really dive in? What do you think?
Yeah, I think it's an interesting thought experiment just to start when you consider that the markets and the news are not a one-to-one relationship. I feel like growing up, and as I was starting to learn some of these things, it was you turn on CNBC or you turn on Fox Business or whatever, and you see all the tickers up and down across the bottom, and Kramer's out there yelling for this or that.
Right.
And there was always something to do. There was always a do this, don't do that, make this move, but you must act. You must act now because this opportunity won't be here long. It's almost like sales. Like you better act now or act fast or the sale is gone kind of thing. And I think it's almost brainwashed us in a sense that we think, and kind of your question almost presupposes that those things, while they do have an impact on the overall market, it's a one-to-one relationship. Russia invades Ukraine, markets fall off the face of the earth. Well, that's not actually the relationship that we notice time after time over decades and even over a century of bad news coming out.
Right.
So then I think the new question becomes, okay, great. Markets don't necessarily move one-to-one with whatever the day's news is. So what do they move based on?
Really good question. It seems like to me when I turn on the CNBCs of the world, shifting it from making good financial decisions towards this is a casino full of speculation. I mean, you have the colors, the sounds, the urgency, like you need to act, or this is the bet you should or should not make. It seems like we're at that point now, maybe more than ever, at least in our relatively short careers up to this point. Is that the way you feel as well? Is investing shifting to a more casino-like gambling, buy this stock and pray, or is there still some merit to how does this build into an overall financial plan? How would you think about it?
Yeah, I think it depends on the person. I think some people are really good at not treating it like a casino at all. But I think you can just turn on the TV and watch a couple of financial commercials, whether it's from Fidelity or Schwab or anyone, even some pretty good players in the game who seem to have really low trading costs and aren't hurting their customers in any way. They're advertising, look at our active trader program, or I think it was Schwab that has a buy this particular theme. They've got stock theme investing. So if you're really into dogs, you can buy dog stocks. And if the dogs are going to go up, then so will your portfolio.
Sure.
And in a lot of ways, it's almost like, and you can see a Fidelity commercial and then 5 minutes or 5 seconds later, you can see a DraftKings commercial, and they almost have a similar undertone to them. You see somebody smiling, taking out their phone, and making a move.
Right.
And realistically, what we've noticed over our shorter careers and what we know anecdotally just through the clients we've worked with who've made it to really successful spots, that rarely have they ever been good when it's I'm waiting at the doctor's office, I take out my phone and I'm placing trades.
Sure.
So those who have not gone the casino route have been the ones who have generated the most wealth, at least in our experience. But it's only getting easier to treat it like a casino. I think that's part of the challenge.
Well said. The path to being able to make those moves is now the easiest it's ever been. It's the cheapest it's ever been, on top of Wall Street just as a marketing source, encouraging you to do those types of things. Whether it is some of the larger players, Fidelity, the Schwabs, even the Vanguards of the world, are encouraging you to take action in some way, shape, or form. You've heard me say this before. When we think about just markets as a whole, if this is where we find entertainment, if this gets our heart beating when we pull out the phone and we're trying to read a chart or incorporate news, find your entertainment elsewhere.
Yep.
Turn on the ball game, go watch a play, go work on a hobby of yours. Find your entertainment elsewhere. Yep. Rarely is good investing a really fun source of entertainment. It can be fun to read about and become more knowledgeable, but rarely does that heart-pumping investment actually make sense for you long term.
Yep, completely agree.
Let's switch gears here a bit. So far, we've talked largely qualitatively, and we'll continue to do that. I think that's an important part of our discussion today and the impact that we have on the people that we work with. But I do want to review with you, where have we been so far this year? Boy, have we covered a lot of ground. I can't believe it's the middle of September. It seems like we're still in quarter two in many respects. Before we switch gears and talk numbers, one of my pet peeves about any webinar or anything that I listen to is there's always a shift to talking about markets in terms of a matter of fact. It's very cold. It's very impersonal. It's very such market is up 10%. This is down 5%. Investors made $1 billion. Investors lost $100 billion. It's very impersonal. It takes the relationship element out of it. I want to point at that and really bring that to the top for us today. As financial planners, we lean into the emotion. In fact, saying, well, I don't take emotion when I invest is still taking quite a bit of emotion.
100%.
Recognizing that this matters for those watching, certainly for us, this stuff matters. This looks like retirement. This looks like kids' college plans. This looks like paying off a home early. This looks like making ends meet. So this is very real, and I want to make sure we acknowledge that instead of being so cold and just matter of fact. I want to take a second and just point out this is serious and this matters, which is why we wanted to do the webinar in the first place. How can we encourage you to make good decisions with your resources? At risk of talking out of both sides of the mouth here, let me switch gears. So far, as of this morning, the S&P 500, so roughly America's 500 largest companies, is roughly up about 12% so far this year. The more tech-heavy NASDAQ, still American companies, is up about 16% so far this year. And then, of course, international markets have done quite well so far this year, is up about 22%. Now, that's the upside, right? We know the story so far this year through roughly the first 3 quarters. The downside is this, Jeb, and here's where I want to get your opinion. At one point this year, for most of these indices or markets I just pointed out, early April posed as the low point. At one point this year, the same S&P 500 that is up 12% was down about 19%. The NASDAQ that is up 16 right now was down about 23%, almost a quarter. And the international markets that are up 22% still lagged at one point this year at about 6%, losing 6%. We have seen volatility. It seems like that's been the buzzword this year and in years past. How do you approach that from a planning perspective and your professional opinion? We have definitely seen, things rock back and forth, to say the least. What are your thoughts and observations?
To bring in just a slightly nerdy term, which we're going to do our best to avoid, but when we think about why do we invest in these markets in the first place? Let's take it back a little qualitative. It's to meet all the needs of the things you already mentioned, whether it's maybe we plan to build a vacation home in 10 years, and that money should be invested with a certain end goal in mind, a certain amount of safety, a certain amount of upside. Similarly, for a college investment plan, is your child starting college in 2 years, or were they just born and you're starting to plan 18 years out? That's going to affect the posture we take when we invest into these markets. These markets, we believe, over a long period of time, are the best way to be fairly hands-off and to generate significant wealth. So that's the reason that we do invest in these markets. So when we look at these markets, the S&P, the NASDAQ, the total international markets, they always have an end goal associated with the investment, right? So when we're talking clients through where to put their money, there's an end goal in mind. We're thinking about whether it's a college goal, whether it's investing for a vacation home in 5 years or 10 years, or a retirement goal. This is the place where you can be fairly hands-off and generate significant wealth. But why is that? Why do they continue to grow? And part of that, and here's a bit of a nerdy term, is the volatility premium. The reason that markets return what they do over a long period of time is there is a significant amount of volatility, upside and downside. Think of an investment that only goes up on average 8 to 10% a year with no volatility. Every single person in the world would be rushing to that investment. If you remember, real quick, just a quick aside, when inflation was extremely high back in COVID times, there was this concept of an I bond, an inflation protected bond. And it was a 10% guaranteed payout over a year. You had to jump through all these hoops to go get into it. But when someone said 10%, you'll give me 10%, well, that's just as good as the market. We want to go do it. That's incredible, and those opportunities only happen this often. There was a bunch of other government hoops to jump through, and it still probably didn't make sense for most people, and it wasn't worth the headache that it ended up causing them.
Sure.
But when we think about these markets and why they go up the way they do, part of my question would be, well, what's the alternative? There isn't anything that returns like this over a long period of time, and part of the reason that they do that is their significant volatility nature. So again, we went from minus 19 to up 12 in the S&P 500 just this year.
Right.
In April, nobody was calling us saying, let's get in. Let's get in. People were freaking out, and rightfully so, because of how this potentially throws into jeopardy, at least in our minds, emotionally. Do my kids get to go to college? Am I going to be able to build that home? Right. Am I going to be able to retire?
Right. Let's pause and unpack. When we throw out the word an investment or investing, a common misconception I hear an awful lot is investing means we are pushing all of our chips to the middle of the table.
Yep.
We inherently have to be very aggressive. We could lose it all, or we could lose half in a short amount of time. While certainly those kind of investments exist out there, unpack a little bit more for the audience, different kinds of investing, especially for shorter term goals. When is it appropriate to have more of a concentration in the markets that I just mentioned versus maybe being much more conservative than the volatility premium that you mentioned we see in those?
Absolutely. So this goes back to a financial plan. We're big on a financial plan. And investing, how you're actually going to allocate the money, is one of, if not the last steps in a good financial plan. We need to define, what is this money even for? I've already given a few examples of things it may be for. We need to define what it's for, when it's going to be for, and what is your appetite to see your money go up and down between minus 19 and up 12 within, we're really talking about 6 calendar months.
Yeah, short.
So a lot of times we hear markets and people think, oh my gosh, my money is down 19%. Well, for most people, that's not actually true, because what we want to do is bucket your money in a way that makes sense for your goals, so to speak. So to be specific, cash is an investment, especially when you hold it in a money market or a CD, something you want to get a good yield on your cash at the market rate. But there's no volatility in holding cash. You're falling behind inflation potentially. That's another whole topic to unpack in a different webinar. Right. I'm sure that folks are familiar with that as they go to the grocery store. But when we think about cash, that's for, okay, if I'm going to build a house next year, well, I don't want to have that invested in the S&P 500, which we know can go down 19%
very quickly, right?
Pretty fast. Well, now you get 19% less house than you thought you could. So we want to be planning with the end goal in mind. A very rough framework to think about this would be maybe 1 to 3 years. Is that short term, that kind of a cash allocation? Maybe 3 to 7 years, something in the middle. We think of bonds. We think of bond funds that give us exposure to different maturities, different, whether it's the United States, whether it's international bonds. And then 7+ years and definitely 10+ years, we tend to think of stocks as being the best place on a diversified basis to generate that wealth, to make sure that your money is outpacing that inflation and that you're able to meet those long-term goals, the retirement, the education, which, oh, by the way, tends to have a higher inflation associated with it, meaning we need to have a higher return associated with it.
Well said. So here's what I'm hearing you say. I want to tie this back to kind of the initial question. Let's just take that first part. Why is the stock market continuing to climb? What I'm hearing you say is, well, it ain't climbing for free. There's a price of admission to getting on that ride. We should let the plan be the overall North Star that we are following, and our investment strategy, whether aggressive, moderate, or at some points very conservative or cash-like, should reflect that. So we're talking today just specifically stock market, but for those of you watching, depending on your goals and your needs, what you are envisioning this money to be used for, the stock market may be a really inappropriate vehicle to use, especially for very short-term goals. I think that's the value we attempt and we do a good job of bringing to the table for the people that we work with. Right? How do we actually organize and architect a financial plan and make sure your assets are a response to that? So volatility, there is a price to come with it. But what I'm also hearing you say is, thank goodness that there's volatility. If it was just linear and it went up with very little risk to no risk, well, we wouldn't build a whole lot of wealth off that at all, and we certainly wouldn't compound it over time. Is that what I'm hearing you say?
It is. That's what cash does. So maybe the interest associated with cash goes up and down depending on the environment of the day, but that's what cash does, and it's not a great place to build long-term wealth. So to your point, there has to be a relationship between risk and return and basic economics. So when you consider volatility, it's kind of the price of admission. You know what you're signing up for, and that's also partly our jobs. That's absolutely piece of this webinar is to help you understand, hopefully, that this comes with the territory. And over a long period of time, especially over significant timelines, this is worth the risk. But it's not worth it over 1 year, generally speaking. If you have $100,000 that you're trying to put, again, down for a kid's college next year, they're a senior in high school, the last thing you want to do is turn on the news and see that markets are down and start to say, oh, goodness, do we need to maybe not apply to that school but change to the technical college or whatever it is in this example.
So if we have the belief, and I think there's a lot of evidence to support this, that markets, especially in the very short term, are virtually impossible to predict, and even more so impossible to actually act on in a way that is constructive. You've heard me say this many times. One of my favorite quotes: predicting rain doesn't count, building arcs does. There's an awful lot of weathermen out there and weatherwomen out there. there's not a whole lot of contractors.
Not at all. Yeah.
So there's a lot. It is easy to put a headline up on CNBC, a little ribbon running across the screen, or one of the talking heads doing what they are paid and incentivized to do. It's much harder to actually take action, be successful, and then make that a repeatable process.
100%.
It's virtually impossible to do that well. The data would suggest this as well. This is not anecdotal in just our careers up to this point. There's a group called Dalbar that looks at the average return of a lot of the indices that we've talked about so far. So American companies, large, medium, small, and international companies, they track just the absolute performance of those indices, and they compare those with investors that are invested in a very similar way to those indices, but we get to see the difference in actual performance. They will run this in a running 30-year or so timeline. So they're not cherry picking just a couple years at a time. Jeb, it's frightening to see the average investor lagging the average indices by quite a substantial amount when we think about this long term especially. You are not immune to those behavioral biases. We aren't immune to them. You all watching are not immune to them. I think it's more of a question of how do we recognize them and make sure that doesn't get the best of us.
Yeah.
As an investor and as planners, we aren't attempting to change who somebody is, but we are looking to push them in front of the mirror a little bit with them and ourselves included to say, what are our tendencies? What does money mean to you? What is your relationship with money? That naturally spills over to your relationship with investments and risk and volatility. I think that may be one of the most important jobs we have as planners. I'm not sure if you would agree or not.
I definitely agree. I mean, you can put the best plan in the world together and execute it effectively for 10 years and do everything right and make every right decision. And 2008 comes along and you're freaking out and you say, I just can't handle it. And you take all your money out and you miss a 20% recovery in 1 year. Think about what missing out on 20% does to your long-term returns.
Wrecks it.
So we know the way that these markets compounding is exponential, and we as humans, I think, really struggle with this concept of exponential numbers. I took too much math in college, so I thought about exponents too much, and I still struggle with it. But losing 20%, even just missing 1 year of returns because our stomachs couldn't handle it or because we made an emotional decision, you can do everything else right over the rest of your plan, the 10 years prior and all the years after for the rest of your life, and you cost yourself a significant amount of wealth based on probably what is one bad decision. So that's where we try to step in as advisors and as educators, helping clients understand that there will come a day where you're going to want to make an emotional decision, and how do we not have you take out your phone and make the one trade that changes everything.
I know you and I are meeting with an awful lot of people where a substantial portion of their savings are in just a handful of companies. Especially the financial media has kind of dubbed them the Magnificent Seven, the Apples, the Teslas, the Microsofts, the Nvidias of the world. While those are great companies, we have seen dropping performance, especially in the last couple years. When we talk about risk, I think that's what comes to mind for me. It's not necessarily commenting directly on those companies and saying, I think it's going to go up or go down. One of the most important jobs we have is trying to put that into context. Do we have to take that level of risk to be successful? Or what are our alternatives? You mentioned a really important concept that I wanted to circle back and spend some time on, this idea of seeing headlines in concert with your investment balances or performance. I think you are alluding to, and I'll throw the hot potato back in your plate here, when we see things really go down or really tensions are high, the headlines are incessant, we do not see investors really pounce on those opportunities. We always tell ourselves that we'll just buy the dip, or we'll buy when everyone else is scared. We're going to be the Warren Buffett of the world, and we're going to come in and invest and capitalize. Have you seen the data actually support that? What is your anecdotal experience? How would you advise a client who maybe has a ton of cash on the sidelines and they're just waiting for that time to get invested? How has history panned out, or what does the data suggest?
Yeah, it's a good question. It's almost like you knew I had some resources around that. Dimensional fund advisors are a group of academics who do a lot of academic research around finance and manage a couple of ETFs and mutual funds, but they put out things constantly trying to help investors be better investors. And one of their recent pieces was talking about the cost of trying to time a financial market. And starting all the way back in 2000, so almost a 25-year period.
Right.
What would it have looked like to have invested $1,000 and left it in there? What would it have looked like to miss just the one best week over 25 years?
The one best week, or 1 week of the last 25 years.
How would that affect your returns if you missed 1 week?
Wow.
Then they said, okay, well, what about 1 month, 3 months, and 6 months? Really short time periods within this 25-year scope. And my gut reaction, again, not understanding exponential numbers, would be, well, it can't be that big of a difference, right?
Yeah, we're talking about 7 days, 30 days, 60, 90 days of 25 years.
Exactly.
Yeah, seemingly small periods of time.
Yeah. So here's what they found is the week ending in November 28th, 2008 was a huge week in the stock market. That was around the bottom, what would have been right after the bottom of the great financial crisis of 2008.
Sure.
And if you had missed just that week, your $1,000 invested, over 25 years, it would have been $6,604.
So you put $1,000 in 2000 and did nothing else with it. It grows to $6,500 or so,
$6,600. Exactly right.
Okay.
If you missed just that 1 week, you would have cost yourself on a $1,000 investment. You would have cost yourself $1,100. Your returns were $5,500.
Wow.
Just that 1 week.
$6,600 to $5,500.
Correct.
7 days out of 25 years.
Correct.
Whoa. Okay.
Okay, so then let's take it to the month example. So the month is the month ending April 22nd of 2020.
COVID.
Exactly.
Right?
So COVID, we saw a lot of uncertainty, a huge spike down,
Sure.
and then everyone looking for answers and not knowing, okay, where's the bottom? Is this going to be the worst crash of all time? Well, it was recovered in a month. And if you missed that month, then rather than $6,600, your returns would have been $5,274. So you'd have cost yourself even more. And now imagine the type of person who sees this volatility and says, well, I need to get out. The markets are crashing, and I'll wait till things calm down, right? So you've got cash on the sidelines. We hear this a lot. Markets are choppy. I just want to wait till things calm down. As we kind of covered earlier, volatility is your friend when you're investing in stocks. You should want volatility. It's what drives the returns. So here's what I did. I just went and found some news article headlines from the dates of that 1 week and that 1 month, just to say, hey, here's my challenge to you as I read these headlines. If I was your advisor, would you have woken up on one of these mornings and called me and said, hey, I think we need to buy. I've got some cash. Let's go ahead and get it in, right?
I'm dying to hear these headlines.
Okay, so
these are the headlines when we see the markets at a period of stress, friction, to say the least.
Exactly.
Of like really times of worry and concern when your neighbor and your cousin and your friends are all getting out.
Exactly.
What were the headlines?
So Friday, November 1st, 2008, S&P 500 index falls to lowest level in 11 years. Stocks plunged on Wall Street Thursday for a second straight day. The S&P is now down more than 52% below its October 2007 high, making the current bear market the second biggest on record. The current decline is exceeded only by the 83% drop back during the Great Depression. Here's another headline. Citigroup board considers selling off company. The Citigroup fell a record 26% yesterday as concerns grow over the future of the nation's largest bank. Citigroup's board is holding an emergency meeting today. The Wall Street Journal reports the board is considering selling off the entire company to another bank. Earlier this week, Citigroup announced plans to lay off 52,000 workers.
Wow. And that's a bank full of financial advisors or close connections to Wall Street. One would think they have the biggest, the best, the smartest, the best access to information. If anybody should know, it should be one of the mega banks in the country, right?
You would think. And then the final one from that day, jobless claims jumped to a 16-year high. The number of workers seeking unemployment benefits has reached a 16-year high. Last week, 542,000 filed claims for unemployment benefits. More than 10 million people are now unemployed and looking for work. That week, ending November 28th, the total U.S. stock market index returned 6.41%.
Wow.
So right after all these headlines where uncertainty, right? There's uncertainty. No one wants, these are choppy waters. Mm-hmm. No one is calling their advisor, or it's a very special financial mutant who is opening up the app and getting money in when they're reading these levels of uncertainty. Okay, so let's skip ahead for the month that was ending April 22nd, 2020. This is COVID times. Right. We just discussed, if you missed that 1 month of returns during all that uncertainty,
66 to 52.
52, exactly right. So here's one of my, this is a really good article, and I'm just going to read a couple excerpts from it. This is an article from March 21st, 2020. Coronavirus recession looms, its course unrecognizable. This is from the New York Times. Economists say there is little doubt that the nation is headed into a recession because of the coronavirus pandemic, with businesses shutting down and Americans being shut in. But it is harder to foresee the bottom and how long it will take to climb back.
Wow.
The irony of this is March 23rd, 2 days later, was the bottom.
Wow.
The abruptness of the descent and the near lockdown of major cities is unheard of in advanced economies, more akin to wartime privation than to the downturn that accompanied the financial crisis more than a decade ago, or even the Great Depression. So I really want to zoom in on that.
Yeah.
The media of the day is comparing our current times to war, and this is even more dire than what came with the Great Depression or the Great Financial Crisis of 2008. Mm-hmm. Now, we can play the results, and what ended up happening was the month ending in April 22nd, that total U.S. market was up 21.73%. Mm-hmm. So the point in all of this is these are Harvard economists. As I was reading this, it's not like they just called somebody down the street at the technical college. I mean, they're calling the Ivy League best economists out there, and they're trying to understand, okay, well, so where are we in regards to the bottom? And no one would have thought that as they were writing that article, that was the bottom. Mm-hmm. Coronavirus was an extremely unpredictable time. Sure. But what we ended up seeing was it was already the bottom and a very quick return. And again, just missing that month of returns would have set you back significantly from a long-term wealth generating perspective.
So if we take that after your sentiments and we apply that to the overarching question here, let's attack the second part of that question. Despite everything else seemingly falling apart, the times that you mentioned were not fun and games.
Not at all.
There were no sunshine and rainbows. We are not attempting to trivialize the panic, the health impacts, the loss of jobs, careers that those time periods contained.
100%.
I think we recognize that, but we also recognize the importance of having your plan, sticking to it, not letting the sky fall on you, or having the belief that you can avoid this completely.
Yep.
So that combined with understanding how the markets generally behave, we know this is a resilient force, even in the face of so many terrible events that go on in the world, even just this year as an example, combine that with there's really no good way to act on it in a repeatable, dependable way.
100%.
Overall, let's talk through some action steps for our viewers and the people that we work with. A lot of this information is great. I think you would acknowledge that information is excellent and planning is excellent. Actually implementing said plan and having the discipline and accountability to stick to it, even when it's falling out of fashion or your peers around you are not exactly sticking to their plan or whatever that may look like. What comes to mind for you as we talk through action steps? What is something actionable our audience can take with them?
Yeah, I think it is. We keep kind of wearing out this concept, but start with the plan. Do you have a defined plan? When you think about the stock market, you're thinking about playing Wall Street again on your phone or behind your computer or even over the phone with a stockbroker. Your plan should inform the way that you engage with these markets. If I would kind of challenge our audience right now and ask yourself, do I engage with markets because of the planning that I've already done? Or do I view it as a casino where I'm just trying to play the markets and figure out a way to get in and get out and make a bunch of money? Because as we've already discussed, first of all, the people who approach markets that way, based on that Dalbar study and plenty of other studies out there, rarely, if ever, outperform what markets can generate for you if you just leave it alone.
Right.
So again, start with the plan. Don't start with the investments. And then the next challenge would be: does every dollar you have a job? That's the way I like to think about it. Almost like, to do a stupid little analogy, if I'm the CEO of Bowie Enterprises, that my finances, and I'm the CEO, and my dollars are the workers. Well, do they have well-defined jobs? Do I have cash that's assigned to a certain thing, like keeping me prepared for emergencies, potentially paying for a new car as I've got an aging car out there in the parking lot, preparing for a new AC system as I've got an aging AC system on the house, those types of things. Do I have money that is being saved and assigned for retirement? Do I have insurance that's there to take care of me from a medical perspective, or even life insurance? It's there and appropriate to pay for whether it's burial costs or the debts that I'm going to leave behind to my wife. So every dollar should have a definable job, in my opinion. And what I see with a lot of clients is, if I were to put a balance sheet, show you all your assets and all your liabilities, and say, okay, well, tell me, what does this do for you, and what does that do for you, and what is this all geared towards? It's a really hard exercise, and most clients can't do it, especially not the first time they walk through the door.
Well said. Well said. What I'm hearing you say then is, thankfully, and this is totally for our benefit, we do not have to find the diamond in the rough, the tiny company that goes public, or we trade it on the markets at the perfect time in order to be successful.
Not at all.
That doesn't mean your portfolio is infallible, and there will not be periods of drawdowns and recessions. The COVIDs and the 2008s almost certainly will happen again. It will look different. It may rhyme with what those events have looked like, but times of stress and pressure will almost certainly happen again in the future. We like to make changes investment-wise when your life changes, not when the market changes. We know the markets are going to change, but how do we actually assign your resources? I like the concept of giving your money a job. Give it a due date, give it a use date.
Yep.
I really enjoy your sentiments on that. And I think we talked about earlier, really taking a candid assessment of how much risk are you actually taking.
Yep.
We throw that around, or we hear that quite a bit just in the industry, like, make sure you know how much risk you're taking. But actually, taking a step back and saying, well, maybe having a substantial portion of my money in a handful of companies or trading on them actively, perhaps it is not a good place for us to be, or we're not being compensated for the risk that we're taking.
Yeah.
Jeb, as you know, it's very easy to take risk. It's much harder to be compensated for the risk that you're taking.
Mm-hmm.
That's effectively finance and investing in a nutshell.
100%.
Right? That risk and return trade-off. What do our roles as financial planners, and we will end on this, what do our roles as financial planners look like? For those of you watching who may be unsure of what their cash is doing for them or how much risk they're taking, perhaps you watching are finding yourself feeling uneasy. The headlines are really tough to get away from, and the noise is loudest when you're sitting next to the speaker. What can we do as financial planners in a trusting relationship that we look to build with the people in which we work with? What do we offer people at a high level? Self-dealing here a bit.
No.
Biased, of course,
it's a great question, and whether it's us or you can do this by yourself, I think the main question people are trying to answer, when you boil it all down and you keep asking questions, it all ends up working towards, am I going to be okay?
Well said. Well said.
So what we do as planners is help you answer that question over and over again, hopefully a couple times a year if you're willing to come in and give us an hour or hour and a half or 2 hours, depending on how talkative we all get that day. But what we want to is over and over again help you answer the question, am I going to be okay? While understanding that life is going to throw curveballs at you over and over again that we can't anticipate. Mm-hmm. But what we try to do is model your finances within a reasonable level of certainty or confidence that you will be okay, that inflation could do a crazy thing for a long period of time, or markets could do a crazy thing for a long period of time, and you can still be okay. One thing that I really think just should be mentioned before we kind of sign off here is we talk about markets being down 19% this year, and that's a crazy kind of a number.
Sure.
But what we have is we haven't seen a significant period of long-term decline, long-term being more than a handful of months,
right,
in a long time. The last time we really saw something like that was 2008.
Right.
2022 was a tough year. A lot of people lost some money in 2022, but not in the way of 2008. And I think it's worth emphasizing that those 2008-like crashes do happen. Mm-hmm. Unfortunately, as I hope you understand and the way we've unpacked this, we can't anticipate when exactly they're going to happen. Mm-hmm. And over a long period of time, those end up being wealth-generating opportunities rather than wealth taking away opportunities, for lack of a better
diminishing
word.
Instead of
growing,
you're taking away.
Exactly.
Makes
They're not
sense.
wealth diminishing.
Mm-hmm.
Now, they are over a short period of time. But I want to, again, just mention to folks is we've been lucky to see quick trips down and quick trips back up.
Right.
And that's really not quite how the roller coaster has operated over a longer period of time. Mm-hmm. And I think now is as good of time as ever to define a plan and prepare for what would it look like for my assets not to lose 20% and rebound within the same year,
right,
but what would it look like for my assets to go down 20, 30, or 40% over a year. And we're reading headlines about jobless claims and not knowing when the bottom is. Like, defining right now with a trusted source, how will you respond in that time? Mm-hmm. Because it's really not a win if it's going to come. It's a win.
It's a win.
We know it will come at some point. We just don't know when, and there's no way to actually prepare for it.
Sure. And maybe to answer the question or attempt to answer the question after our discussion this morning, when we talk about why is the stock market climbing, recognizing what a powerful force and what a powerful tool it is.
Yeah.
But Jeb, as with any powerful tool that we approach, we have to do it responsibly.
100%.
We have to have an appropriate level of education in order to use the tool to its capacity.
Yeah.
And we also have to be prepared for when that tool doesn't operate exactly how we drew things up in our mind. Yep. Recency bias is real, right? We're off a stretch of, again, jaw-dropping growth and a handful of companies and overall markets doing well. What does it look like when that tool isn't as helpful as maybe it's been over the past just couple years, maybe barring 2022? But then the second half of that question, despite everything else seemingly falling apart, while we know those periods happen, and they will certainly continue to happen, it's virtually impossible to know when they're going to happen and what exactly to do to either mitigate yourself, pull out, feel safe for a little while. I think you've done a really good job of unpacking why that's actually much more dangerous than just having your plan, sticking to it, as long as we understand how much risk we're taking with this tool called the stock market. So while our answer isn't exactly black and white and just crystal clear, as there's so much to unpack in that question, we always want to lead first with the plan. What is the money to be used for, instead of treating this as a fad diet where we give it a shot for a couple months and we pull out when we're not exactly overjoyed to stick to it. This is a lifelong commitment for most 100%. People, right? You're an investor for life, not just when the sun is shining. Anything else to add before we wrap up?
No, I think it's, again, prepare on the front end, know that there will be choppy waters, whatever analogies you want to use. But now, during times of markets really returning and being good and being comfortable, is the time to start preparing for any discomfort and just checking in and making sure you have an answer to that question. Am I going to be okay?
Yeah, and that's something we do during all periods of the year. I hear a common misconception, well, what goes up must come down. And while there's a lot of truth to that in the physical world or physical laws, stock market doesn't exactly adhere to the physical laws of gravity, let's say. In fact, as investors, we would want markets to continue to climb and build wealth and innovate over time. So saying just because all-time highs are being hit doesn't exactly mean this is a poor time to invest or you should stop contributing or change your financial plan as a result of that. I like the saying the best first aid is prevention in the first place. While we can't prevent markets going up and down, we can prevent how we approach them. How knowledgeable are we about them? What's baked into our plan? What are we assuming? That's a really good way not to prevent money being lost. Money will be lost, but our actions that oftentimes accompany that potential loss along the way. Thanks so much for joining me this morning. I appreciate it. Maybe this will be the first of many as we try to get in front of our audience. These are questions you guys are thinking about. You're asking us. They're really good. But we are here as a force for financial good and try to keep our eyes on preventing and keeping you out of making the big mistake that is so easily made and even encouraged by a lot of those trusted sources, quote unquote trusted sources, Wall Street, the big banks, the media at large. We're here to help you swim upstream as we go through your financial life and the importance of your financial plan. Thanks so much for joining us.